welcome to the deep dive.
Okay, so you've given us the rundown, the top 10 crypto and blockchain stories, September 15th to the 21st, 2025. And looking through them, it was quite a week. A lot of speed.
It really was.
Yeah.
Yeah, velocity is a good word for it. Across all these sources, you definitely see a clear pattern emerging. This wasn't just random news. It feels like real momentum.
That's what we thought too. So our mission today is basically to boil these 10 updates down, try and focus on what seem to be two huge trends happening kind of at the same time.
Okay.
First, you've got the accelerating integration of traditional finance TradFi. It feels almost unavoidable now.
Right.
And second, there's this massive technical push, for scalability. Got to handle all that volume somehow.
Exactly. And I think the backdrop for all of this, the real starting point, is this renewed confidence in the market. The sources are pretty clear on that.
Yeah. How so?
Well, you can see it in the institutional capital flows.
Yeah.
It's coming back in a serious way. It's validated. This isn't just talk anymore. It's actual deployment of funds. And that changes everything we're about to discuss, doesn't it?
It absolutely does.
Okay, so let's start with the regulatory side then, because that seems like the key unlocking the door for the institutional money you mentioned.
Makes sense.
We saw something pretty significant with altcoin ETFs, right? Grayscale filed a revised S1 for a Dogecoin ETF with the SEC.
Yeah. And look, Dogecoin might, sound like a bit of a meme.
Right.
But the filing itself, the regulatory process, that's serious.
So what's the real significance there? Is it just about Doge?
Not really, no. It's more about the precedent. This builds on the successful launches of existing regulated ETFs for things like XRP and, yes, even Dogecoin previously. So the key takeaway here is that the market, and importantly the regulators, seem to be getting comfortable with regulated products for assets beyond just Bitcoin and Ethereum.
So it's like altcoins are graduating.
Yeah.
Moving from just pure speculation to something fund managers can actually package up.
In a regulated wrapper, exactly. That's the idea. It becomes a productized risk they can manage within existing frameworks.
But doesn't embracing something like Dogecoin in an ETF, doesn't that kind of dilute the whole narrative, that crypto is becoming this serious financial thing? Is it institutional acceptance or just retail hype getting packaged?
That's a really good question. And I think the answer is, well, asset managers follow demand, yes. But more crucially, they follow regulatory signals.
Okay.
The fact that the SEC is even allowing these S1 discussions suggests they're okay with the framework for altcoin derivatives.
So the fund managers aren't necessarily saying Dogecoin is the future of finance.
Probably not, no. They're providing regulated access to the price exposure. It's about the mechanism, not necessarily an endorsement of the underlying assets, let's say, fundamental value.
Got it. And speaking of mechanisms and money flowing in, we saw some big numbers last week, really backing up that institutional confidence point.
We did.
Bitcoin ETFs pulled in over, $2.3 billion in net inflows?
Yeah, their best week since mid-July. That's significant.
And Ethereum ETFs bounced back too, right? Over $638 million in new capital.
That quantification, those numbers, they really anchor this whole conversation. It shows institutions aren't just dipping their toes. They're making real commitments.
They're using the tools, the regulated products they now have.
Exactly. But that comfort, it stems from legal clarity. Which brings us to that joint statement. The one from the SEC and the CFTC.
Right, the big two. When they speak together, everyone listens. What was the main message there about spot crypto trading?
Well, the core point was really about clarifying the existing legal framework. They basically affirmed that registered exchanges can trade certain spot crypto assets. As long as they meet the existing pretty strict regulatory requirements. So it wasn't about new rules, really. It was more like, okay, here's how digital assets fit into the plumbing we already have.
Formalizing the playground, maybe? Making it safer for those billions we just talked about?
That's a good way to put it, exactly.
Okay, so the regulation's getting clearer, the capital's flowing, but then you hit the next hurdle, the infrastructure. Can the system actually handle it?
The classic bottleneck.
Which leads us straight to that technical push. We saw Ethereum devs setting a target date for a big network upgrade.
Yeah, and you can see the demand driving the urgency there. The goal, the anticipated impact, is an 8-fold scaling increase.
8-fold, wow.
Specifically targeting Layer 2 solutions. And if you look at what they're aiming for, it's mainly about slashing transaction costs and boosting throughput.
Because otherwise,
all the successful institutional adoption we're seeing, it would just clog up Layer 1. Fees would skyrocket, and high-frequency institutional use becomes, well, economically impossible.
Makes sense. And Ethereum's not alone here, is it? Polygon announced plans, too.
Right. Competition's heating up. Polygon said they're aiming to boost their transaction capacity by 33%.
Which sounds like they're specifically targeting the stablecoin market.
Absolutely. It looks like a strategic play. I mean, stablecoins are kind of the workhorse for institutional settlement in crypto.
So boosting capacity by a third, that positions them as a potentially really efficient way to move large amounts of stablecoins around cheaply.
Exactly. It's becoming a scaling arms race. The network's no efficiency is the name of the game now.
And this whole need for performance for efficiency, it loops right back to TradFi, doesn't it? Through real-world asset tokenization, RWAs.
It does.
Fidelity launching that tokenized U.S. Treasury fund, and they picked Ethereum to do it.
And the platform choice there is almost as important as the asset. You've got Fidelity, a giant institution, taking something totally traditional like a U.S. Treasury.
Super low risk, globally understood.
Right, and putting it onto the blockchain. It lets investors get that stable, traditional exposure, but through a crypto-native platform.
Yeah.
It's more than bridging a gap. It's like digging a tunnel. Makes the value exchange between the two worlds much smoother.
But what about the technical side of RWAs? Tokenizing a treasury must be way more complex than just issuing a stablecoin, surely.
Oh, definitely. It has a lot of operational complexity. You've got compliance, custody issues, legal jurisdiction. It's complicated.
So Fidelity needs Ethereum to be rock solid.
Incredibly reliable, secure, finality guaranteed. Those scaling upgrades we just talked about, they're basically essential prerequisites for this kind of institutional reliance. If the network glitches, it's not just code affected, it's a real-world asset. The stakes are higher.
Okay, shifting gears slightly, but related. Over in Europe, Valor, that's DeFi Technologies subsidiary, they launched something interesting on the London Stock Exchange.
Ah, yes, the Bitcoin staking ETP.
World's first physically backed one, right?
Correct, and that's a landmark because it bundles two things institutions want. Regulated exposure, like any ETP, but also yield generation from staking.
So investors can get Bitcoin staking yield without actually having to do the on-chain staking themselves, with all the complexity and risk that involves.
Precisely. It packages it up neatly. It makes that yield component accessible to a broader, compliance-minded audience that might not touch on-chain stuff directly.
So with all this scaling, regulation sorting itself out, money flowing in, the market mood was pretty bullish last week, predictably. Bitcoin's price action was quite aggressive.
It was.
Analysts were pointing to BTC clearing the $115 liquidation pool, aiming for CME gap near $117 case, and even eyeing a bigger liquidity cluster around $119 2K.
Right. Those are very technical terms. Maybe we should quickly unpack what they signal.
Good idea. So clearing a liquidation pool at $115 K, that means?
It means a bunch of leveraged short sellers got forced out of their positions as the price went up, which can actually add fuel to the rally. Shorts getting squeezed.
Okay. And the CME gap at $117K.
That refers to a price difference between where the regulated Bitcoin futures market on the Chicago Mercantile Exchange closed, say on a Friday, and where it opened on a Monday. Markets often tend to drift back to fill those gaps so they can act like price targets or magnets.
Gotcha. And this wasn't just wishful thinking, right? There are metrics supporting this bullish view, like high funding rates and open interest.
Exactly. High funding rates mean traders are paying a premium to keep their leveraged long positions open, showing strong bullish conviction.
They expect the price to keep going up.
Right. And high open interest just means there are a lot of active contracts, indicating deep market engagement. So yeah, the technicals seem to align with the upward move.
There's always a but, isn't there? This positive feeling has to be balanced against the risks. As the market gets bigger and more serious, the risks grow too. We saw that new report on crypto crime last week.
Yeah, and the numbers were, well, pretty sobering. Around $3 billion estimated stolen just in the first half of 2025.
$3 billion. Wow.
And it wasn't just the amount. The report highlighted how sophisticated the hacks are getting, and maybe more worryingly, that a lot of the stolen funds were being laundered before the attacks even became public knowledge.
So the criminals are highly organized, moving fast, even ahead of the news cycle. That's concerning, especially with institutional money coming in.
It raises a massive security challenge, absolutely.
And that leads us straight back to the regulators having to respond. The New York Department of Financial Services, the NYDFS, they put out specific guidance for banks in New York dealing with crypto.
They did, and the message was pretty clear, pretty uncompromising, actually.
Which was?
Basically that these banks must use sophisticated blockchain analytics tools. It's not a suggestion. It's a requirement for playing in this space now.
Mandated compliance.
Mandated compliance. You can't integrate with this new system, especially with theft numbers that high, unless you have provably strong measures to fight illicit activity. It's basically the price of admission for TradFi integration now. Security and oversight have to scale alongside the capital. #outro.
So wrapping this all up, looking at the whole week, from altcoin ETF filings to mandated bank analytics, what's the big picture takeaway for someone looking at these sources?
Well, if you synthesize it all, I think the market's trajectory right now is really defined by this tension. You've got massive acceleration in capital inflow, driven by things like ETFs and RWAs.
The integration push.
Right, and that's slamming right into this absolute necessity for technical and compliance upgrades. You need the scaling on one side, and you need the rigorous oversight on the other. They have to happen together.
Yeah, we saw that efficiency push, Ethereum's 8x goal, Polygon's 33% boost. Countered immediately by that mandatory oversight like the NYDFS demanding specific analytics tools.
It shows the market isn't just about speculative hype anymore. It's about institutional readiness. Speed, efficiency, security, regulation, they're all tangled up now.
Not separate stories. Two sides of the same coin, really.
Exactly. Two sides of a financial system that's maturing incredibly quickly.
So, here's something to think about as you look through your sources again. As this market keeps maturing, which force is going to end up putting more pressure on how these decentralized systems are actually designed? Is it the sheer demand for speed and efficiency needed for layer 2s and RWAs to function? Or is it the non-negotiable demands for security and oversight, the things regulators need to feel comfortable? Speed versus mandated security. Which one ultimately shapes the future? Which force are you going to track more closely?
Yeah, reflect on that pressure point, because how that tension resolves, that's likely where the next wave of both innovation and regulation is going to focus.
Definitely something to mull over. Okay, that's all the time we have for this deep dive. Thanks again for sharing your sources with us. We really encourage you to keep digging into them yourselves.
Absolutely.
We'll catch you next time.